This is Brad Sanders. This is your investment update for February of 2020. A tough month for the markets. Everybody knows about the coronavirus at this point. The S&P 500 dropped 12% the last week of the month to close year to date at down 8.1%, and about the same for global stocks, or 8.2% for the S&P, 8.1% for global stocks. We did have some positive bond market activity, which you would expect in that kind of an environment. So I think we've mentioned the coronavirus before. We've certainly been mentioning it with client meetings here. So here's what's going on with this and why the market suddenly became into a panic. This virus originated in China. China accounts for 15% of all transactions that have to do with global GDP. So that's a lot. They're the second biggest economy next to us. And this virus, because of what it is, unlike SARS and things like that, it's contracted very easily. It's not quarantined very easily. And now this has been going on since early January, and we're finding out now that it's spread quite a bit more, and now it's in 16 to 18 different countries, depending on the day. I should mention we're recording this on March 3rd. Again, the markets are very fluid, so by the time you see this, things might have changed a little bit, but this is the morning of March 3rd. What's happened is this is going to cause a lot of supply-side disruption. China is the largest manufacturing economy in the world, and so they make a lot of things that the rest of the world uses. And what we're going to start to see over the next coming months is global GDP data become very weak. And that's what the markets kind of woke up to. The narrative had been, oh, this is no big deal. This is like all these other virus things. And the markets had largely shrugged it off. And then the data worsened and it started to hit Italy and these other countries. And it became very readily apparent that this was not going to be like SARS. This was going to actually have some measurable impacts to the global economy that are then in turn going to filter into the markets. And the market priced all that in 1 week. It dropped 12%, okay? Or 11.4%, 12% at the lows. The selling was very disorganized, as it typically is when the market's dropping 4% a day. A lot of things didn't make sense. And that's what you can expect when you're in kind of a panic market. As things progress, we would expect the market to get a lot more orderly as things kind of adjust in real time and people start to really get a handle on what's going on. We would think level heads would arise and you wouldn't see such violent movements. You would see something much more orderly in nature as we move forward. The 10-year Treasury has dropped down to almost 1%. It's at 1.09 as of this taping. It's had a big drop in the last 2 days. And the Fed this morning came out and did an emergency 50 basis point rate cut. Okay, that's the Fed responding to the market and responding to the propensity for global economic data to deteriorate very quickly in these kind of environments. The problem is the market was up this morning, the Fed cut interest rates, and the market fell and is now down about 1%. So that's, probably a pretty worrisome sign. That's probably a sign that we would expect further volatility from this, that this is not over. Generally, if the Fed eases that much in a surprise move, you would expect a big bounce in the market like we had yesterday. And the market is instead taking this as kind of a bearish signal that things are going to continue to worsen. So this is why we continually preach risk management at all times. We can do these videos and talk about global GDP and earnings and the stock market and all this stuff, and what's caused a problem is a virus that originated outside of the United States that nobody saw coming. So this is why it's always important to continue to do those kind of things and have your portfolios balanced and ready to go, because things can change at any moment. This is a very fluid situation. I'd love to sit here and tell you that the message can be, oh, this will be over quickly. I don't think that's the case, and the market's action certainly says it's not. So I would expect more volatility, more messages from us over the coming month as we kind of learn new things and kind of see some directionality in the markets. But it's too early to expect a V-shaped recovery. So we're going to continue to monitor this, but that's kind of where we are at the moment. And we'll talk again to you soon.